Plenty of people have concerns about stock market volatility. We've been talking about it a lot the last couple of weeks here on the show, but we're going to steer in a little bit different direction on today's show. If you're worried about a potential recession, if you've got fears of the overall economy amidst some of the stock market volatility that we've had, I'm sure you're also starting to think, if you're close to it, or if you were preparing to retire this year, right, should I still do it? Should I still pull the trigger? So whether it's 2025 or 2026, since we're kind of approaching the halfway point of 2025, I think either year really applies to this question. Is it a bad time to pull that trigger? Is it a bad time to retire? We're going to ask Frank, financial advisor, on today's show and find out if that's the case. Walter Strohol back with you alongside Frank Oliver, financial advisor with Oliver Asset Management. And Frank, it's a big question. I'm retiring this year, or at least I was planning to. Right. And now the volatility's made me nervous. I don't know if I should. So you've helped us put together a checklist today to kind of walk us through 5 questions, 5 points for people to think about to kind of better prepare for answering this question. Is it a good time to retire or not? Yeah.
I don't think I would look at killing my entire enjoyment of what I've worked for 40 years of my life over, 3 bad months of the market or 2 bad months of the market or 3 bad weeks of the market, and if we look at this, so don't panic. You definitely don't want to panic. That's the first thing I put
Step one.
Step one, don't panic. And if you look at your overall situation, right? Say you've been investing for 40 years, and let's say your portfolio was off 10% this year. Okay. If you take 40 years of investing, if you would have earned 10% less over that entire 40 years, would you be freaking out? Probably not. Look at that, right? I mean, it's what, 0.1% a year or something like that? Yeah. So if you look at, the 10% pullback that maybe you've experienced in your portfolio right now, but if you average that out over 10 years, you never would have noticed it if you would have earned 10% less over the last, 40 years. So I don't think, it's a good time to panic. I think if you want to retire, you can still do it. Look at building a plan, seeing how much of these funds you actually need to retire. Do you have additional savings out there? Social Security going to take care of you? I just think you need to look at all of the numbers in the full picture before you panic.
Yeah, that's a good point. And it's also like you talk about a 10% drawdown, but it's not like that's going to be your entire retirement plan is going to be pulled straight from the market, straight at this moment.
You're really going to use a portion of your retirement for the next 12 months. Right. You can leave the rest of the money in there and let it recover, Yeah. And again, like we talked about on one of our other episodes or another topic was year over year, we're still up 7 or 8% as of right now.
Yeah.
So
if you had retired last year, you would have gone through this thought exercise.
You're still up from where, you still are better off today financially than you were April 23rd of last year if you would have stayed in the market.
Yeah. Yep. Okay. That's good to consider. So don't panic. Tip number 1.
Right.
Tip number 2 is to go ahead and consider your risk exposure or your exposure to risk. So if you're feeling very panicked, that's a really good sign that this is something you should probably do.
Yeah, I think so. And we look at risk a little bit different here. I do when I build financial plans is we use a bucket approach. Have a cash bucket, have an income bucket, and have a growth bucket. Okay. So I think when you're considering risk, I think people look at their entire portfolio, right? Well, I think if we got 6 to 12 months cash in a money market fund, it's still earning a little over 4% right now. That's a good cash position. We are going to go through tough times in the markets. It's not going to stop after this, right? So 3 to 5 years in some principal protected account. If we got 3 to 5 years that we can rely on, knowing that there's some growth if it's going to, if the markets recover, but you're protected from losses, and then that'll give you your feel good, your safe haven for 3 to 5 years. And then look at, adjusting the risk exposure for your 5-year out bucket, your long-term investments. Okay. And just reallocate and look at that every 3 to 5 years, but you don't need to de-risk your entire portfolio, but you could be taking on too much risk, with the money you need for the next 12 months.
Yeah. Yep. When I came in today, I asked Frank if he's been getting a lot of phone calls from clients upset or nervous about how the market's been the last couple of weeks and months. And it was kind of interesting. He was like, no, it hasn't been that crazy.
Not bad at all, no.
Market's been crazy, but the phone calls haven't been that bad. No. And that's because if somebody's planning to retire this year or next year, but they've got a plan in place, they don't have the reason to panic like someone who doesn't have that plan and is just seeing all of their money exposed to these whims. Right.
Yeah. But we set up expectations when we build these plans. So when people have a plan built by us, we have so much money in the 3 to 5 year bucket. Okay. We have so much money allocated with a little bit different risk profile to it. And we make sure there's enough cash to ride out these storms. So, our clients are well positioned for these these events that happen. So haven't fielded a lot of phone calls due to that process.
Okay.
So that's good. Yep.
Another step somebody could take if they're finding themselves a little frustrated through the financial markets this year, in addition to not panicking and thinking about your risk exposure, is to look for opportunities to diversify. What would that mean to you through a period like this?
Yeah, there's a lot of talk out there right now about the Mag 7, maybe having their valuations a little too high. They've pulled back significantly, right?
Yeah.
So again, a lot of analysts, and I tend to agree with this to some degree, is that looking at the broader S&P 500, so the other 493 companies versus the Mag 7, maybe using an equally balanced S&P 500 versus the S&P 500 that is really relying on the Mag 7 for between 20 and 30% of the performance of the S&P.
Okay.
And if those Mag 7 companies do not pull out of this recent decline, then that could impact the S&P 500. Nobody knows for sure, but having a little bit broader exposure with the equal weight may make sense.
Okay. Yep. So when somebody's going through times like this, or if they're about to retire this year and they come in to meet with you, looking at their diversification, looking at their mix of assets is going to be par for course.
Yep, I think so.
Okay.
Absolutely.
Sounds good. Another tip, if you're going through the market downturns and the volatility right now, is to think long term. Try to zoom out a little bit. Don't have that short term focus so much, and that's going to make you feel better.
Right. Definitely. I mean, investing has always been long term. It cannot be short term. I mean, if it was short term during COVID, you would have lost. If it was short term during 2022, you would have lost. If it's short term in April of this year, we would have lost. So investing is always long term. It doesn't matter if it's in the stock market, even real estate. I mean, real estate had a real tough spell back in 2008. Interest rates impact that quite a bit, but over the long run, look at what's happened with real estate and the stock market.
Yeah,
I bought my first house at 25 years old, right here in Longmont, and I still remember I paid $88,500 for it.
$88,000. Wow.
Yeah, right on the tracks. Right, it's all I could afford. And painted it myself, fixed it up myself. I drove past it the other day, and it really is still a pretty rough neighborhood.
Okay.
$450,000.
Oh my gosh.
Right.
Wow.
Right. 820 square foot house.
Time in the market.
On the railroad tracks. Yep. Right. Exactly. Yeah. Time in the market.
Amazing. Amazing.
Yeah. It's not timing the market. It's time in the market.
And that goes for the stock market as well as real estate. And
absolutely. Both. Yeah. They're both investments. So.
And long term doesn't have to be 20, 30 years either. I mean,
no.
Depending on your perspective and your goals, 5 years can be a long-term viewpoint.
Absolutely. Yep.
So it's definitely not like, even if you're 60 and you're thinking, I can't think long-term
it's not the
anymore.
rest of your life. It could be 5 years.
You can still think long-term.
Exactly.
Yeah. All right. Last but not least is to assess what actually affects you. And we put you in all caps. Assess what affects you. People get really wrapped up in things that actually don't impact them individually a whole lot.
Right. So what this says, what we put together, is people often overestimate how much income they're going to need from their investments. For example, if you're a couple retiring with a pension and a couple Social Security benefits, living in a house with no mortgage, it's possible that you might not be relying on your investments very much, if at all, during the early years of your retirement.
So you're getting stressed about a market downturn that doesn't actually impact you until 10 years from now when you need that money.
Right. And you see a client that's got $1 million portfolio, for example. The market pulls back 10 or 15%, and they are freaking out that they don't have that $100,000. Well, they still don't need that full $850,000 or $900,000 to support their lifestyle for the next 12 months, right? They'll be fine. Shave off a little portion of that. Look at electing Social Security benefits. If you got a pension, that'll help out. You don't need that full 900,000 this year, million or 850 or whatever that value is. So,
yep. Good points. Yep. Well, all of these wrap back into number one, which was don't panic. And
do not panic.
And don't make knee-jerk reactions and moves without a plan in place. The only thing that you should do as a knee-jerk reaction is to get a plan in place if you don't have one. That's the one you can be urgent about. And if you'd like to meet with Frank, whether that be in person or remotely from wherever you may be, you can find the link to schedule an appointment with Frank in the description of today's show. It's the easiest thing to do and the best first step to take to get in touch and start putting together that better financial plan. Again, all you have to do is check out the link in the description of today's show, schedule that consultation, and take it from there. Frank, thanks for all the help today.
Thank you, Walter.
All right, we'll see everybody next time.
Take care.
Investment advisory services offered through Creative One Wealth LLC, a registered investment advisor. Oliver Asset Management and Creative One Wealth are unaffiliated entities. Licensed insurance professional. This information is for educational purposes only and should not be construed as advice or a recommendation for your specific circumstances. Investing involves risk, including possible loss of principal. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. We are not affiliated with any government agency and do not provide tax or legal advice.